Hello viewers, welcome back to Already Late. I am Dr. Alok Chhajed, and in this video I will tell you about the risk associated with investing in debentures. Before understanding the risks, let us first see what a debenture is. We know that the financial market consists of borrowers and lenders. Borrowers include companies who need money to grow their businesses and governments who need money to develop the country. On the other side, lenders typically include banks, financial institutions, and individuals who have surplus savings. One form of borrowing this money is by giving ownership to the lender, which is commonly known as equity, and the other is by paying interest on the borrowed amount, which is called debt. A debenture is a debt instrument issued by companies that borrow money. It is an acknowledgement of the money being borrowed. Most debentures carry a fixed rate of interest, and the money which is borrowed is repaid at the end of a fixed tenure. Debentures can be secured by some form of collateral, or they might even be unsecured. Let us consider a simple example. Let us say Reliance Industries wants to raise 1000 crore rupees for 10 years. It decides to issue debentures each valued at 1000 rupees. That means totally Reliance will issue 1 crore debentures. Reliance promises to pay 9% per annum to the person who purchased these debentures. This means anyone who purchases these debentures will get 90 rupees per year per debenture and 1000 rupees at the end of 10 years. Though the debenture is issued by Reliance for 10 years, you can sell your debenture to any other buyer at a mutually agreed price. This price is known as market price, and it is different from the 1000 rupees, the price at which Reliance issued, which is known as face value or par value or even maturity value. The market price depends completely on the demand and supply for that debenture in the market. Now the question is, why would anyone want to purchase this debenture from Reliance? Now this debenture in the example was offering 9%, while money in other safe instruments which guarantee returns like banks and governments currently offer between 6% and 8%. The investor is definitely taking a certain level of risk because though unlikely, there is still a chance of default by Reliance Industries. It is for taking this extra risk that the investor is being offered the extra return as an incentive. Now, if instead of Reliance Industries, let us say a lesser known, less profitable company offers a similar 10-year debenture to you at the same 9% per annum, will you purchase it? Definitely not, because the risk in this case is higher, and as a result, 9% is not as attractive to make you interested in buying this debenture. The company will have to offer you a higher interest rate, let us say around 11%. Now we can say that in case of Reliance, the perception and probability of a default was less than that in case of the other company. This risk of default, that is non-payment of interest and principal amount, is known as credit risk. Credit risk is a measure of the creditworthiness of the company issuing the debenture. The creditworthiness is measured by specialized agencies known as credit rating agencies by providing a rating to the debenture. The ratings are mostly in the form of alphabets similar to grades in your school. There are many credit rating agencies and each one has their own way of rating nomenclature. Now in school, A plus was better than A was better than B, and so on. Similarly, in case of rating, we can say AAA is better than AA minus is better than A plus, and A is better than B. D is usually reserved for default category and indicates default by the company in honoring its payment obligations. We will do a detailed video on rating nomenclature and their meanings little later. An investor in debentures should look at the credit rating of the debenture and understand the same well before investing. It will be unwise to look at the interest rate offered by the debenture and get attracted to it without considering this risk. If the interest rate is in line with the risk and you have an appetite for such a risk, only then you should look at investing in a debenture with low ratings. Else, you are advised to be with a debenture giving lesser rate of interest but with a solid credit rating. Now you might have another doubt yet. is credit rating applicable for governments too, or is it only for companies? Now, when government issues debentures, should I still worry about a credit rating? Does a country also have a credit rating? The answer is yes. Now, this rating, however, depends on the overall fiscal management by the government and does not change very frequently. And if any change happen, it is a major news, and you will definitely watch me analyzing the impact of that change right here on my channel. Currently, India is rated BBB by Standard & Poor's, one of the very well-known credit rating company. BBB, what does BBB mean? BBB here means that Indian government has adequate capacity to meet its financial commitments, but could be impacted if economic conditions worsen. So overall, nothing to worry at this juncture about government securities. So dear viewers, I hope you now have a clear idea about credit risk and how this risk can be understood before investing in any debenture. In the next video, we will look at the other risk affecting investing in debentures, which is interest rate risk. Thank you. Keep learning.